Insight into auditing. Overview of audit risk. What is an audit risk? Audit risk is the risk that an auditor expresses an inappropriate audit opinion on the financial statements that contain certain material misstatements. In other words, it is the risk that auditor fails to express an appropriate audit opinion in an audit assignment. Components of audit risk are 1. Inherent risk. 2. Control risk. 3. Detection risk. Combined level of inherent risk and control risk is also known as financial statement risk. Mathematically, audit risk is a product of inherent risk, control risk and detection risk. Therefore, we can say that audit risk equals to inherent risk multiply control risk multiply detection risk. Talking about risk, audit risk and detection risk are related with the auditor and dependent on the audit procedures applied by the auditor during the course of audit. Whereas inherent risk and control risk are related with the management, and these risks are independent to the auditor. Audit risk process. As discussed earlier, audit risk is a product of following three risks. Audit risk, which the auditor sets as acceptably low level for the audit. Inherent risk, which is inherited risk of event or process. Auditor assesses the inherent risk. Control risk, which is related with the internal controls designed and implemented by the management. Auditor assesses the control risk. Detection risk, which is related with the audit procedure adopted by the auditor. Auditor plans the acceptable level of detection risk. Inherent risk and control risk is also called financial statement risk, and these risks are related to risk of material misstatement. Understanding of audit risk. In any event or process, inherent risk implies the total error or misstatement available prior to applying any control measure. Out of total error or misstatement, some error or misstatement are caught by the internal controls designed and implemented by the management. Out of remaining error or misstatement, some error or misstatement are caught by the audit procedure of the auditor. The remaining undetected residual error or misstatement is the audit risk of the assignment. Let's have a look at the pictorial elaboration of the concept. Let's consider events or processes as a beaker and element inside beaker as error or misstatement due to inherent risk. Let's consider controls implemented through internal controls as first infuser silo, and audit procedures applied by the auditor as a second silo. Internal controls are designed and implemented by the management to detect and prevent errors or misstatement. Therefore, when controls are applied in the inherent risk, that is when we pass the element of beaker into infuser silo of internal control, it detects errors or misstatement. However, few errors or misstatements may be undetected or bypass the controls. The risk that material errors or misstatements are not detected or bypass of controls is called control risk. during the course of audit. Auditor reviews these events or processes, and auditor prepares its audit procedures to get reasonable assurance that financial statements are free from material misstatement. However, some material errors or misstatements may not be detected by the audit procedures applied by the auditor. The risk of failure to detect material errors or misstatement by the audit procedures is called detection risk. After the completion of audit assignment, whatever undetected residual risks are left, they are called audit risk. Inherent risk. It is also called IR in short form. Inherent risk is the susceptibility of an account balance or class of transactions to misstatements that could be material, individually or when aggregated with misstatements in other balances or classes, assuming that there were no related internal controls. In other words, risk that has existed in the absence of any action or control or modification in the event. Control risk. It is also called CR in short form. Control risk is the risk that misstatement either individually or when aggregated with other misstatement could not be prevented or detected and corrected on timely basis by entity's internal control system. In other words, it refers to the risk that internal controls fail to detect the material misstatements. Detection risk. It is also called DR in short form. Detection risk is the risk that auditor's substantive procedures are unable to detect a material misstatement that exists in the financial statements. In other words, it is a risk that auditor fails to detect the material misstatement in the financial statements being audited. Interrelationship of the components of audit risk. There is inverse relationship between financial statement risk and detection risk. It means when assessed financial statement risk is high, auditor should plan the acceptable level of detection risk to low. In contrary, when assessed financial statement risk is low, auditor can plan to accept high detection risk and still maintain the audit risk to acceptably low level. Detection risk matrix. Auditor plans the acceptable level of detection risk based on the assessment result of inherent risk and control risk. There are 9 scenarios of acceptable level of detection risk. There will be 5 different acceptable levels of detection risk, that is lowest, lower, medium, higher and highest, based on which auditor defines substantive audit procedure to be applied during the course of audit. Response to assessed risk. Let's take 2 scenarios for discussion. 1. If there is high inherent risk and high control risk, auditor should maintain lowest detection risk in order to reduce the audit risk to acceptably low level. 2. If there is low inherent risk and low control risk, auditor can accept highest detection risk by maintaining audit risk to acceptably low level. Sufficient appropriate audit evidence. Amount of required audit evidence to qualify as sufficient. Appropriate audit evidence is based on assessment of financial statement risk and planned detection risk of an auditor. There are 9 scenarios based on the level of financial statement risk and planned detection risk on an auditor. Those are: in a nutshell, we can say that audit risk refers to the risk that an auditor expresses an inappropriate audit opinion when the financial statements are materially misstated. Audit risk is the product of inherent risk, control risk and detection risk. Audit risk refers to residual risk which is not detected by the internal control and audit procedures. There is inverse relationship between detection risk and combined level of inherent risk and control risk.
Thank you for watching. For more videos, hit subscribe button below.